Hey, welcome everybody. Thanks for joining us today on this very snowy, wintry morning here, at least in southern Minnesota where I'm located, for today's webinar on extended care planning, where we're going to discuss everything that you need to know about long-term care planning and how to protect your assets, your income during retirement and beyond. My name is Ben Bernard. I'm the insurance director here at Ascent. Where Ascent Financial is a consulting and financial services provider here in the upper Midwest. We focus on insurance planning, wealth management, and we have a very comprehensive farm transition planning department as well. And today we're partnering with Greg Mantz here from One America. One America has a couple different unique ways to fund and to plan for planning for long-term care expenses. One America is a leading provider in this area. They're our experts. They've been a huge resource to my team here on the insurance planning side, as well as a lot of clients that we've worked with over the years. Really, I guess the next thing is just kind of some housekeeping things. If you have questions, don't hesitate to ask. We want this to be as interactive as possible so that the attendees can get as much out of this as possible. So there is underneath the chat feature there is where you can type in any questions that come up along the way. And again, thanks for carving out some time to spend it with us here today and learn about long-term care planning. So without any further ado, I'll turn this over to Greg Mantz with One America.
Hey, thank you, Ben. Appreciate it. So yeah, as Ben mentioned, we do have everybody muted. So if you have any questions, feel free to type them into the chat box, and we'll kind of address all the questions at the end. I'm going to speak for probably about 20 minutes to 25 minutes, just to cover, like Ben said, some of the bases of extended care planning. And what I'm actually going to do is I'm going to go use my whiteboard here. So I'm going to actually flip over cameras. So bear with me as I make that change.
Okay, so it's my job to help advisors like Ben put long-term care plans in place. I'm a certified financial planner, and long-term care insurance is what I do. So I work with advisors like Ben, and our job is to be a resource and a solution for any long-term care questions or concerns that you guys might have. So maybe to start with, what is extended care planning? I think there's this misconception that extended care means, we think that it means nursing home. And that's part of it, but that's not everything. In fact, it's probably a smaller part of it than it is a bigger part. Long-term care is simply the need to have assistance with things that you can do today on your own. Okay, it doesn't mean that we're in a nursing home, it just means we need assistance. Okay, a good word to think of when we talk about long-term care is the word frail. And the reason being, it helps kind of, to me at least, it makes sense that the older we get, the more frail we become. And as we become more frail, we just need assistance with those things that, again, we can do today by ourselves. So those things we define as activities of daily living, or ADLs for short. You may have seen that in the past. There are 6 of them. They are the ability to bathe yourself, the ability to eat by yourself, to dress yourself, to transfer, meaning to move, like say out of bed or move yourself around. Toileting, so the ability to use the bathroom yourself, or for lack of a better word, the ability to be able to hold it when you need to go to the bathroom. Those are the 6 activities of daily living. And we look at those as an industry, and we say 2 out of 6 is kind of the threshold for what we consider extended care. And that means if you're unable to perform 2 out of 6 of those 6, then you're eligible for, in our case, long-term care benefits, or we would consider that an extended care situation. The other triggering event, if you will, is something we call severe cognitive impairment. So that would be something like dementia, or dementia caused maybe by Alzheimer's, where maybe even like physically you're fine, but cognitively you need assistance. If you have a severe cognitive impairment, that's considered extended care as well. So best case scenario for all of us is we live a very long and fruitful life, a very happy life, As we get older, we become frail. We need assistance with these things. That's what extended care is. At no point there did I say that you're in a nursing home, right? Again, that could be part of it, but it's not the whole story. When we look at extended care, how long, on average, do we need care for? Well, for men, the average is at about 2.2 years, and for women, it's 3.7 years. Now, these are a little misleading because there are a lot of very short stays where people need care for, say, a month and then pass away, unfortunately. So those tend to skew it towards the shorter end. If we look at a more traditional definition, so somebody that's made it a year essentially with care, so more of our, more in line with our 2 of 6 activities of daily living, more in line with our severe cognitive impairment. Once somebody's made it a year, these numbers change quite a bit. In fact, the male number climbs to 4 and the female number climbs to 5. So we see a lot about averages and planning for averages. So I would say this, at a bare minimum, if you're doing some planning, we should consider this as our average, 4 to 5 years, not 2 to 3 or 2 to 4. Right? We should plan for something longer. And then keep in mind as well that when we're talking about averages, roughly 50% of cases exceed the average, right? It's more or less right in the middle. So it's very likely that you could have a claim or a need that lasts for 6 years or 7 years or 8 years or 10 years for that matter. When we look at Alzheimer's, the average length of a need for Alzheimer's is actually 8 years. So quite a bit higher than just these averages. And again, that's just a typical case. My wife's grandmother, for instance, needed care in a facility for about 6 years. She needed care at home for at least 2 years prior to that. So she was actually above that average. And in my experience, that's pretty typical of Alzheimer's cases. Another number I like to talk a little bit about is the probability, if you will, that you might need long-term care at some point. Would you believe that it's 70%? 70% of people are going to have some need for long-term care during their lifetime. And if you think about a couple, so you've got a husband and wife, and they each have a 70% chance of needing long-term care. What are the odds that one of the two of them is going to need care? Right? This one or this one. Well, if you do the math on that, it's actually north of 90%. So I think it's safe to say there's a very high likelihood that somebody will need care at some point in the future. And if there's a high likelihood for something, it's something that we should plan for, right? This is why it's so important to have some sort of long-term care plan. Okay, so speaking of numbers, what do you think the cost of care is? It's a rhetorical question, I know, but just to share some numbers with you, in the state of Minnesota, the average cost for care in someone's home is about $6,000 per month. Again, that's for home care. So that means to have somebody come into your home, to do homemaking things, to help you with certain 2 of 6 activities of daily living, to help with those ADLs, all that kind of stuff. You're looking at about $6,000 a month. For a facility, it's actually quite a bit more. It's about $11,000 a month. So that means then that we're paying $72,000 annually for care at home, and we're paying north of $130,000 for care in a facility. And again, these are just the averages. I've seen facilities that are $15,000, $16,000 a month for a private room, the best type of care that you probably want. So needless to say, it's quite expensive. Now, depending on which state you're in, it can vary drastically. In Iowa, I cover Iowa for instance, the average cost of care at home, in a facility, is about $8,000. So it's $3,000 less than in Minnesota, but still quite expensive. When we think about some trends that are going to impact prices as we move forward. Things to keep in mind are demand. We think demand will go up for long-term care. Well, why is that? Well, we have the largest generation in history that's getting to the age where they're starting to need long-term care. We have the baby boomers. Fun fact, no baby boomers are 80 yet. It's 2022 when I say this. Baby boomers are in their mid to late 70s. They'll be turning 80 soon, and right around age 82, give or take, is when people are most likely to need long-term care. So if you're trying to, dial in an age for a plan that you're putting together, age 82 is typically the age that I'll use when I do that. We see demand going up for that reason. We are also seeing increases in life expectancy. So over time, we expect the trend to continue to go up. We actually saw a decrease a couple years ago. You might remember seeing that on the news. Due to COVID, was the first time life expectancy dipped for quite some time, but the long-term trend is that it will go up. We expect, by the same token, lengths of claims or lengths of stays or lengths of need for care to increase as well. We expect that 4 to 5 year average to go up. That's partially due to life expectancy. We're seeing people live longer, but at the same time with better medical technology, people are recovering from things they never used to be able to recover from. We're living with things we never used to be able to live with. So all those things lead to us likely having a higher length of time needing care. Also, I think this is very important and cannot be understated, or cannot be overstated. It's awfully understated. We'll call it family availability. We expect family availability, it's gone down, and we expect it to continue to go down. What do I mean by family availability? Well, best way to explain it is illustrate it to you. I'm from North Dakota originally. My parents live in the middle of North Dakota. I live in the Twin Cities. I'm 8 hours away to the east. My sister is 14 hours away, way in western Montana. It's likely that if my parents need care, neither of us are going to be there to be able to provide that care. We're going to have to explore a professional option, or at least figure some things out at that point. Point is, we're not right there to be able to provide care. And we've seen that as a trend as technology has gotten better, as it's easier to travel back and forth across the country. We've seen the availability of family locally decrease by quite a bit. And of course, that feeds into demand, right? All these things feed into demand, which feeds into price, which feeds into length of time, and so on and so forth. So they're all related. But these are some of the key trends that we see in the industry moving forward. So we talked a lot about the financial side of it, but before we kind of dig into what some of the solutions are, I'd like to just share with you what I think is probably even more important, and it's the family side of this piece of the puzzle. If I asked people, Mrs. Johnson, if you needed care, who would provide the care? I usually get one of two answers. I get spouse or children. Now, the thing is, when we talk about caregivers, whether it's a spouse or a child, if you have a family member providing care, or even a friend for that matter, a lot of times it has a very detrimental impact on their quality of life. So some of the things that we see stress go through the roof. I have at home, I've got 3 kids at home right now. I've got a great wife, but we are, as you can imagine, there's a lot of stress in the situation. Now imagine what happens if you were to insert having to provide care for somebody in addition to that. Just providing care causes a tremendous amount of stress, not just the care itself, but the wondering about the well-being of the person, worrying about that person, so on and so forth. It is oftentimes a full-time job to be providing care. So it has a significant impact on this caregiver just through the amount of stress that they have. And of course that impacts their health. Right? It's very difficult to find time, especially with 3 kids at home, to work out as is and to keep myself in fairly decently good physical condition as is. Now, again, imagine having to provide care and how little time you would have. In addition to that, stress impacts health, things like lack of sleep, high blood pressure. A lot of times there's weight loss or weight gain simply because we can't take care of ourselves the way that we'd like to. So again, big impact. Also, just the family strained relationships. I mean, imagine the relationships with your children's kids or your grandkids, for instance, not being around, not being able to go to the baseball games, the football games, those sorts of things. And oftentimes caregivers have to quit their jobs to be able to provide full-time care. So it just has a serious impact on all these things. The other piece of it that's oftentimes forgotten is the relationship between the siblings. So now imagine you have one sibling or child providing all of the care. How does that make that person feel to their siblings? Right. One of the things that we want for our children is we want our children to have happy lives. We want our children to get along as well as they can. Oftentimes when they get to adulthood, that gets a little more difficult. There are micro fractures in those relationships. So imagine all of a sudden you come in here and you wedge those things further apart. A lot of times there's resentment that builds up as a result. Think about financial stress. Forgetting how to spell here. Think about financial stress. You might have one child that's providing most of the financial support for supportive equipment and medications and all those things for their parents. The other children aren't necessarily helping out, or the caregiver doesn't feel like the other people are helping out enough. It doesn't take a vivid imagination to see how this can really start to pry some of those relationships apart. And unfortunately, that's oftentimes what we see, especially after someone passes, and you see one child had provided all the care, thinks they're entitled to more than the other children, and that can drive a serious wedge into a lot of these relationships. So just from the family side, there's a very, very important reason to have at least a plan in place. Okay, so if we consider professional care, and we consider the fact that, maybe professional care is the best type of care for our family members or for us, how do we pay for it? We already talked about finances a little bit, but how do you actually pay for it? Well, there's kind of three ways you can do it. You can self-fund, which is essentially using your own money to buy it. You can purchase insurance of some sort. Long-term care insurance is what you need. Or you can let the government pay for it. Now, this option, if you're not familiar, there is no readily available government plan for most people to pay for long-term care. Okay? I think a lot of times when we meet with people, they think there's something out there. There's not. Okay? The program that pays for care for most people on the government is Medicaid. You might be familiar with Medicare. Medicare is for people generally age 65 or older. Medicaid is for people that don't have many assets or much income. So people that generally don't have a lot of money. So how do you qualify for Medicaid? Well, I just said it's for people that don't have a lot of money. So how do you qualify for it? Well, you spend all of your money. And that's essentially what the backup plan is, or the default plan rather. If either one or three are attractive, these two are linked. Because the way that you get to this one is you start funding it yourself. If you need care, you use your own money. The whole process actually of spending your assets down to qualify for Medicaid is called Medicaid spend down. Okay, so you have to spend most of your money. Every state's got a little bit different about the amount that you can leave. But generally, you have to spend most of your money to a point where you wouldn't want to do that, generally speaking, right? You spend most of your money and then you can qualify for government assistance or government paid extended care. But of course, again, if you have to spend all of your money to do it, it's not really the best plan, right? So if this is your plan, you start here and you end up there. If you have significant assets, you might start here at self-fund and say, well, I don't need insurance because I've got enough money in the bank that if a risk comes up, I can pay for it for 5 years, 6 years, whatever it might be. And that's very true. You can absolutely do that. We see a lot of people choose to go that route, but I would argue that there's probably better ways to leverage your money to pay for those costs. And you still have a risk, because if you do end up with a 10-year claim or an 11-year claim or something very long, it's likely that you're going to spend a good chunk of the money that you've worked your entire life to save. So that's an option. Or we could look at purchasing insurance. And we'll talk more about how the insurance products work in just a second. Let's go back to self-funding though. One of the ideas or the images I like to use a lot is when you self-fund, if you have a bucket of assets, you're essentially putting this bucket of assets at risk because you can spend your money down and we don't know where it's going to stop, right? What insurance allows us to do is to put a backstop in place, essentially to say that, hey, we draw a line in the sand, we're not going to spend our money past this line, right? It allows us to do that. If, however, we do choose to self-fund, the thing that I think that we should consider is our money being used most efficiently? And what I mean by that is this. Let's say that you have a bill to pay for long-term care, and let's just say it's $1, right? How do you pay that bill? Well, you take money out of your bank account or your checking account, right? Where does that money come from? Well, if it's in a bank, okay, if it's in a bank savings checking, you have to withdraw $1 to pay $1 worth of expenses. If it's in another source, though, a lot of people have most of their money in IRAs or in 401ks and qualified sources. If it's in an IRA, how much do you have to withdraw to be able to pay $1? Well, money that comes out of an IRA is taxed. The entire amount is taxed as ordinary income. So that, depending on your tax bracket, is probably somewhere around $1.30. So I have to distribute $1.30 out of my IRA just to pay $1 worth of long-term care expenses. You could say the same thing about investments. If you have money in mutual funds or stocks or anything like that, this money, you're going to probably end up paying capital gains tax to the tune of $1.15 or more to get $1 after tax to pay any sort of long-term care bills. Now, if we can use insurance, though, and this is where the value is with long-term care insurance, is we get to leverage our dollars. Depending on the type of policy we buy and the coverage and our age and everything else, it's probably somewhere between 20 cents and 40 cents on the dollar that we would use to pay $1 worth of long-term care expenses. So that is an immediate leverage and an immediate return on your money if you should need long-term care. So for anybody that's considering self-funding, think through this and think about what assets would you use to actually pay for care, because as you can see here, there's a lot more efficient ways to do it than to use your IRA or your investments to pay for long-term care. As far as insurance goes, there's really two types of insurance contracts out there. There's what we call traditional LTC, and there's what we call asset-based LTC. Now, traditional long-term care is a lot like health insurance. You pay a premium, you have coverage. It's that simple. Asset-based long-term care is something where we build an asset, which is why it's called that. We create an asset and then we leverage that asset to make long-term care benefits available. And I'll explain more in detail how that works. But just to start with traditional, it generally is the most cost-effective option. So if you want a $6,000 a month benefit, this is probably the cheapest way to get it. However, there are some challenges with traditional. These are some of the things that we hear time and time again. One of the biggest concerns for people is there's no guarantees. So your rates are not guarantees. It's likely that your rates will go up over time. If you have a policy already, you've most likely seen your rates go up. We have clients that get letters all the time for their rates going up 40%, 50% or more. It's not uncommon. Still very cost effective, but again, no guarantees on the rates. And at the same time, there's very little, if any, residual benefit. And what I mean by that is if you don't use your benefit, it's essentially gone. So just like health insurance, if you don't go to the doctor in a given year and you don't use up your deductible or use your health insurance, you don't really get anything back. Long-term care is a lot like that, where there's not really a strong residual benefit. There may be some residual benefits, but it's pretty minor compared to what you might see with asset-based long-term care. One of the other challenges we see with traditional care is the length of coverage. And what I mean by that is how many years the benefit might pay. You can select, you can kind of dial it in with traditional insurance where you could have a benefit pay for 3 years or 4 years or 6 years, but it is limited. There is a cap on it. Our asset-based options actually have options without any cap where it could pay forever. Again, I will talk through that. So right now in the market, we see about 25% of money going to traditional products, and we see about 75% as a long-term care market of dollars go into asset-based long-term care insurance. So it's becoming more and more popular. One America actually created asset-based long-term care insurance back in 1987. So we've been doing this for a long, long time. We've got more history in this asset-based market than anybody else. So as mentioned, we create an asset. And that asset is a life insurance policy or an annuity, both insurance products. What this does for us is it allows us to take and put an asset on the books that's your asset. So again, compare it to something like this where there's little residual benefit. Well, now we've built an asset that's yours. And then we can leverage that, again, to create long-term care benefits. There's also a secondary, or not secondary, I wouldn't say, but a key feature in addition to the long-term care benefit, and that's a death benefit. If you don't use the long-term care benefits, a death benefit is paid out to your family. And depending on the way it's structured, that could be more than the money that you put in, could be about the same, or it could be a little bit less. But it's usually, it's usually somewhere around the premiums that you put in or a little bit more. And again, if you never use it, you get something back that's substantially higher than you get with traditional long-term care. In addition to that, there are guarantees on the premium. So whatever premiums like we show at One America, those are 100% guaranteed never to increase. So you'll never get a letter in the mail that says your premiums are going up. It's all set in stone from the get-go. And then lastly, the length of coverage. Well, we have the ability to put a lifetime benefit on. We're the only company in the industry that does this. Again, we've got this long history in this industry, so we know how to manage these products appropriately. That's kind of our bread and butter and has been for over 30 years. But what that means is it means instead of having a cap for like a 3-year benefit or 5 or something like that, 6 years, we can actually create a benefit that you can't outlive. So you could put a policy in place that will pay, say, $6,000 a month, and it will pay it forever. If you need care for 30 years, it will pay for 30 years worth of long-term care. Our longest claim right now is going on. It's been going for about 18 years or so. Like I said, we've got a lot of history in this. How does asset-based long-term care work? Well, to get in a little bit more detail, let's say we've got a sample case. And let's say that you're 60 years old. We've got a 60-year-old couple. Okay? We build the asset first. So as I said, we start with a life insurance or an annuity. In this case, let's say we have a $200,000 life insurance policy. So we bought a $200,000 life insurance policy. And then what we're able to do is we're able to access 3% of this number every month for long-term care. That's where the long-term care benefit comes in. We build the $200,000 death benefit, and then we can get to 3% of that every month for long-term care purposes. So 3% of $200,000 is $6,000 a month. So either the husband or the wife here, or both, could get $6,000 a month for long-term care purposes. If they both needed it, well, they'd each be entitled to $6,000. So if they both needed it, they'd be entitled to $12,000 total, or $6,000 per person, right? The way that this uses money out of the death benefit is it's just a simple dollar-for-dollar reduction. So if I take a $6,000 benefit for long-term care, it's simply $6,000 less that I have in my death benefit. So after 1 month of $6,000 of care, I now have $194 left in my death benefit. If I take another 6 months out of that, I'm at $186, or $188, excuse me, etc., until we get to a point where we've used up the entire death benefit. And at that point, there's nothing left in the death benefit. But the long-term care benefits can continue, even though there's no longer a death benefit. And the way that that works is there's a second piece to this that's built into our policies called the COB, or the continuation of benefits. So it means that once the death benefit's gone, this kicks in, and if we choose, let's say, the lifetime option, we will pay this $6,000 for life, as long as is needed. It's forever, it's unlimited, even after the death benefit's gone. And again, that will be for both people. So if you both needed care, you can get $12,000 per month for life. Again, it's the continuation of benefits that allows this to happen. That's the feature that kicks in and continues to pay those benefits. So very generically, or very simply, this is how it works. We build an asset. Again, we started with $200,000. We can get to 3% of that number per month for long-term care, so $6,000 or $12,000. And once it's gone, the continuation kicks in and allows those benefits to be paid. So hopefully this has educated you on why it's so important to have a plan. We've talked a little bit about some of the statistics. We've talked a little bit about the costs. We've talked about some of the solutions. We've talked a little bit about how asset-based long-term care works. If you have any questions on this at all, please feel free to reach out to Ben. We could get a call together with myself as well. We'll do everything we can to help you out with your questions and to assist you with anything long-term care related. Appreciate your time and have a great day. Ben, I'll turn it back over to you.
Perfect. Thanks, Greg. I really do appreciate a lot of times these webinars do focus in just on the financial side of how things play out when an extended long-term care need happens to a family member, and so I appreciate you spending a little bit of time talking about just the impacts, how it does impact families on the emotional side as well too, and whatnot. So, but looking at the queue, it looks like we got to everyone and their questions for today. So going forward, if you have any follow-up questions or you'd like to take a deeper look into your personal situation and want us to take a look at that with you, we'd be more than happy to assist you with you to do that here at Ascent. My direct number is 507-469-9437, and my email address is ben@ascentmn.com. So there's a little contact info for you, and this replay will be available, or this webinar will be available for replay. So yeah, as we close, I just want to thank everybody for attending today, especially a thanks to Greg there with One America for a great presentation and getting those questions answered. It was my pleasure to have everyone here with us today, and have a great end of your week, and happy holidays, everybody. Thanks.
My pleasure. Thank you, Ben.
You bet. Take care.
Thank you.